Glyn, as we head into the Easter bank holiday weekend here in the UK, it's a good opportunity to reflect on an interesting month of March. How would you sum it up?
Yes, it was an interesting month because we went into the month in, I think, consolidation phase, as we had said it in our last podcast recording. But in fact, it became a really interesting month in mid-month with this problem that emerged in Cyprus. It wasn't a new problem, of course. We've known Cyprus has needed a bailout for over a year, but it became quite a significant event and had a really notable impact on markets over the course of the month.
Let's stick with that for the time being then, as it is the big story. What was the catalyst and what are the implications of the changes in Cyprus?
Well, it was the big event of the month really, and overshadowed pretty much everything else. The issue in Cyprus is the banking system is essentially bust, and that means to bail it out, the country would have been bust. So we've known that for about a year. The problem is that Cyprus has got a massive banking system. It's about literally 8 times GDP. A lot of that money has been sourced from literally Russian money launderers. So the rest of the EU has been very keen to sort this problem out for quite a while. A lot of the Cypriot bank money was then lent to Greek banks, and a lot of that went up in smoke when Greece went effectively bust. So the banking system in Cyprus has been bust. In fact, the amount of money involved required to sort of sort this out is minuscule. Cyprus is a tiny place. It's not even 0.25% of Eurozone GDP. So the amount of money involved is tiny, 17 billion euros. But try and persuade the German electorate to bail out Russian money launderers, which is what bailing out the banking system in Cyprus would effectively have done. That was not an appealing prospect. So the deals that have been negotiated and cut all of them have been involving private sector involvement, with depositors in the 2 big banks, with the dominant banks in Cyprus, losing some money. So I think that's the real crux of it, what we've ended up with, the first deal that was cut in mid-month would have required all depositors, even insured depositors with less than 100,000 euros in the bank, would have required all of them to lose some money. And that's obviously a threshold that has never been reached in the Eurozone through this whole crisis. The Cypriot Parliament rejected that. Investors were very nervous. There's been 2 weeks of intense negotiations, during which the whole Cypriot banking system has been closed down, so people have not been able to get money for a couple of weeks. Imagine the state of the economy. The final deal, a classic Eurozone deal that was done at the very last minute, just before the ECB was to withdraw all liquidity support for Cypriot banks. The final deal actually required uninsured depositors. In other words, depositors in Cypriot banks, the 2 big banks with more than 100,000 euros, required them to lose a significant part of their money, a big private sector bail-in. Insured depositors, anybody with less than 100,000 euros in the bank, would be protected. But of course, people can say, well, this is a one-off deal. Cyprus was a special example. The Russian deposits were a big issue. But investors have sort of drawn a little bit of a conclusion that this might mean that in future bailouts there's going to be a bail-in of bank depositors. So carrying on this theme, what happened during the course of the month is that markets were okay until mid-month and doing reasonably well, and then you've had quite a distinct shift in the market performance. Intriguingly, the big impact has been on peripheral Europe. If this problem had happened 12-18 months ago, I think we would have seen a much bigger problem across the whole global markets. In fact, what has happened is that outside Europe, markets have been reasonably stable. Peripheral Europe has been very weak. So, for example, Spanish equity market down 9% since mid-March, Italian market down 5%, Greece and Portugal worse than that. Bond yields on peripheral markets, Spain, bond yields up by 40 basis points, Portugal 50 basis points, Greek bond yields up by 200 basis points. What this is reflecting is market nervousness about the implications of the terms of this deal for future bailouts. Will it mean a much bigger private sector involvement? And future bailouts, of course, could include Spain, might even include Italy. So, no surprises. Spanish banking stocks have been very weak. Spanish bank paper has been very weak. Same across peripheral Europe. Really, really interesting month as the way this has evolved.
And so overall, in nominal terms, clearly Cyprus not a big deal with respect to the Eurozone, but there are implications and contagion risks which we need to bear in mind?
Yes, I think that's exactly right. Cyprus is not a big deal. It's a tiny country, as I say, it's less than 0.25% of GDP. I mean, the Cypriot economy is well and truly stuffed for the next several years. You know, the banking system has been completely reduced to nothing as a result of this, because most of its deposits came from offshore banking haven, a money laundering centre, which the Europeans knew about, were keen to fix. This has fixed that problem overnight, of course, because nobody's going to be depositing money in Cypriot banks again. But it's been a big employer of people. The economy is really stuffed. But there's no big contagion risk from that. The risk is more to do with what it means for the terms of future bailouts. I mean, there's a little bit of an unknown there. My suspicion is that this is a one-off because of the problem with these Russian deposits. But it's heightened the perceived risk across Europe, and of course it's reminded people that the Eurozone is not out of its troubles. You know, there's a long way to go still. We are no closer to a full banking union than we were 6-9 months ago. And what this situation in Cyprus has told us is that a euro in one country, namely Cyprus, is not worth the same as a euro in another country. Because of course Cyprus, as at today, has reopened the banks. People can withdraw only 200 or 300 euros, and there are very, very strict draconian capital controls in Cyprus, and will be for a very long period of time to prevent a run on the bank. So, yeah, Cyprus is sort of isolated in its size and impact, but it's the implications of the terms of the bailout that have worried markets, and I think will actually continue to worry markets for a little period of time here.
Let's take a step back from the Eurozone for a bit and move to slightly more interesting and positive news stories. Yep. Let's have a look at the US economy.
Well, the US continues to go from strength to strength, and that's why it was such an interesting month. The US stock market is up about 3% for the month. Europe is flat for the month, although down quite a bit since mid-month. Since mid-month, the US market has been flat. The numbers coming out of the US have been really encouraging. You know, the employment numbers, the payrolls for February were very strong, much stronger than expected. Created 236,000 jobs. And I thought a really notable feature in there was employment in the construction sector, up nearly 50,000, the best numbers since December 2008. And that, of course, is beginning to reflect the strength of the housing recovery in the US. We've been saying that for some time, but the US housing market is clearly on a recovering trend. It's a long cycle, very positive. So the numbers coming out of the US have been good. The only sort of fly in the ointment is that has led some people to say that the Fed will begin to ease off. It'll begin to taper off on its quantitative easing program. And there was a little bit of nervousness about that. But towards the end of the month, Bernanke came out and said, well, actually, we're going to carry on as we are for the time being. We'll see how things evolve. But this is certainly a story that will continue to roll as we go through this year. There'll be more discussion about when the Fed begins to ease off on the QE program. And the Fed, of course, will be the first to ease off on this ultra-loose monetary policy.
On the subject of long cycles and QE, how about Japan?
Well, Japan, of course, Kuroda, the new Bank of Japan governor, his appointment was confirmed this month. We knew it was going to happen. He's made some interesting statements. He took a leaf out of Draghi's book and said that the Bank of Japan will do whatever it takes to defeat deflation, which of course Japan has been in for a very long period of time. Japanese stock market has continued to perform extremely well, up 8% again this month, in the expectation of this big monetary easing that's clearly on its way. And Kuroda is talking about extending the maturity of Japanese government bonds that he's going to buy, as well as other assets. And it was, I thought, notable that during the course of the month, the yield on Japanese 10-year bonds fell to 0.5%, the lowest it's been for 10 years. So there's a big expectation here that there's going to be clearly zero interest rates for many, many years to come in Japan, but also huge buying of Japanese government bonds and other securities. I think there's going to be a very, very aggressive monetary easing program coming up. Will Japan run on further from here? Well, it's had a very big run since we first got wind of the fact that there was going to be this big change. So some period of consolidation is necessary. But overall, I think Japan remains a very interesting place to be for this year.
Okay. Sticking with central banks that are undergoing change at the moment, let's turn to the UK. We saw a couple of weeks ago further potential downgrade action there, but generally the economics aren't too bad.
No, the numbers coming out of the economy, it's fair to say, have been a bit disappointing. Growth expectations have been downgraded again. We had the annual budget statement from the Chancellor of the Exchequer during the course of March. It very much kept the austerity programme on hold. There isn't much of a choice. But the weakness in the recovery in the UK means that the time it will take to restore the financial health of the UK, get debt down to more manageable levels, is extended by several years, but it's going to remain on track under the current government. But I think the most interesting thing that Osborne, the Chancellor, did in the budget, he made it clear to the Bank of England that whilst they have this 2% inflation target, and that's being maintained, he said that they would have some flexibility and should focus more on employment and growth in difficult economic periods such as the ones we're in than worrying about the 2% inflation. So it isn't quite discarding the 2% inflation target, but I can tell you it's definitely taken a back seat. And for sure, when we get the new governor of the Bank of England, Carney, in June, we're going to see further aggressive monetary easing from the Bank of England. There's not a shadow of doubt about that. And inflation has been sort of rather parked. It'll come back to haunt us one day, but that's a few years down the track.
Glyn, the extraordinary monetary policy clearly has implications on both dollar currency and interest rates in countries based on the dollar.
Yep.
We've seen some action to try and cool property markets in those regions.
Yes, well, there's a couple of things I'd say about currencies. First of all, we've seen further weakness in the euro and the yen. No surprise that the euro weakened off a couple of percent in March because of what's happened with Cyprus and the concerns there. And again, no surprise that the yen has weakened off by about 1.5% or so in March. The pace of weakness has slowed somewhat, but it looks as if, I think it's pretty clear that the US economy is doing better than any other developed market economy. I think that's going to help to support the dollar still. And intriguingly, the impact of virtually zero interest rates and very loose monetary policy is being felt quite significantly in countries whose currencies are closely linked to the dollar. So Hong Kong is a good example. They've had very low interest rates. The property market has gone through a terrific boom. And we've now seen Hong Kong tightening lending criteria, imposing additional taxes on property purchases, those sorts of things to cool an overheated property market. We've seen Hong Kong do it, China do it, Singapore do it in recent weeks, all of which is having actually a bit of a negative impact on those stock markets. So China and Hong Kong stock markets were down 2 or 3% in March. And indeed, emerging markets generally have been quite weak, incidentally. It's been a relatively poor area to invest. Emerging markets down a couple of percent in March. And to put that in perspective, since markets started this latest sort of run-up in mid-November, we've seen developed markets up about 15%, emerging markets only up 5%. And the developed markets being led very much by the US and Japan.
So to summarise, the month really very much a month of two halves. A reminder of risks in the Eurozone, but generally improving, reasonable economic data.
Yeah, I think reasonable economic data in the US. I think there's been a return to some of the safe haven investments. So things like US Treasuries, German bunds, UK gilts have done well. Yields have fallen by 20, 30 basis points over the past few weeks. A little bit of a surprise there. They look very expensive to us. German bunds, by way of example, yields are now down at 1.25%, very close to the lows of early last year. So some concerns about that sort of the risk-off period we're in. We've been calling for some consolidation in markets, and I think that the events in March indicate to us and confirm to us that we will get that period of consolidation, a little bit of slippage in markets. Still underpinned, of course, by the huge amount of liquidity around. But I think we're going through here a period of consolidation, pause in markets and reflection. And of course, we've had this timely reminder that all is not well in the global economy, and particularly in Europe. So a few challenges ahead, but I think markets will be picking up again as we go through the course of this year.
Great. Thanks, Glenn.